The hardest part of a high-income W-2 professional is they go to their CPA, who I call a historian, and they say, what can I do on these taxes? And the CPA says, max out your 401k, defer the tax. Don't deduct it, defer it. It's such a disservice to high-income professionals. Their variables really increase risk.
Totally.
And when you don't understand the variables, you know what Elon Musk said one time? He said, patents are for losers. All of the stuff that Tesla does, they don't have patents on any of their technology. He said, patents are for losers.
Go make something better than I made. That's free market.
What's up, and welcome to another episode of Cash Flow Conversations. I'm your host, Matt Love. And with me today, we have a special guest, Deyl Kearin. Deyl Kearin. And yeah, I got it. It's a difficult spelling, but I'm excited to talk today. We're going to be talking about real estate investing and the impact that and the opportunity that investors have to make the world a better place through your business, DLP Capital. So Deyl, it's good to have you here.
Thanks, Matt. Yeah, stoked to be here. Stoked to be on Cash Flow Conversations and catch up a little bit. It's fun to meet you a couple weeks back, and
so we met at a. We met at a lifestyle investor meeting with Justin Donald here in Franklin, Tennessee. What a cool story that guy has. Justin's going to be on the podcast here in a couple of weeks.
Nice.
But that's all about how to invest in cash flowing assets so you can create cash flow before retirement years and create a lifestyle you never want to retire from. It's the same thing that I've been teaching for years. So it was a really fun room to be a part of.
Yeah, no, perfectly on brand. And that's, I think Justin's the spokesman right now for that methodology and just passion that people have towards building a life. It's not just building a life that you can retire from, but building a life worth not retiring from, but having the freedom to choose. So that's it's the whole idea.
And it's natural for human beings to get fulfillment in life out of being useful. And the old idea of just retiring one day and cleaning the gutters for the rest of your life doesn't really sound appealing to a lot of people.
No.
And you get to a point where you're working out of choice rather than out of need.
That's right. And my dad I think I told you the story. My dad handed me Rich Dad Poor Dad in college on cassette tape. Thank God, because I never would have read the actual. Listened to it over and over, and just that idea of passive income, financial freedom, and being able to choose how I allocate my time was, just resonated deeply and sent me into a career in real estate, right out of college. So and then it kind of feels like Justin's like the new Kiyosaki, where it just updated a lot and really speaking to this generation of business owners looking to kind of expand their freedom, expand their impact and purpose, like you're saying.
Yeah, totally agree. And when Wall Street Journal calls you the next Warren Buffett, that doesn't hurt.
Doesn't hurt. Yeah. I haven't had that designation yet, but I'll stay below the radar, I think.
Me neither. They might've missed my book, The Entrepreneur's Asset. I'm sure they'll get to it eventually, I guess.
It's on the shelf by the bedside. Yeah.
So let's go over your story here. You were a real estate investor. You've spent time as a college professor, and you found this company called DLP Capital. And now you guys are doing some really cool stuff. Let's start off from the beginning. What did you do after college?
Yeah. So like I said, I had this North Star of creating, passive income, financial freedom, and chose real estate as my lane to figure out, and had a few mentors and a few jobs right out of college, so I could kind of learn what that looked like. And then started my own firm in 2007, 2008. Jumped from a great job, but just knew that, to fulfill, my dreams, my mission, I had to be the GP, the sponsor, the guy that was doing the deals. So I partnered up with a buddy, and then the market crashed, and we didn't see it coming. The irony is we spent like the entire year prior to the market crash trying to buy everything we could. Like we were making offers left and right, talking to investors, and we couldn't pull a deal off for the life of us. Like we couldn't get the debt, we couldn't get the equity, we couldn't get the deal. For one reason or another, we just couldn't pull it off. And after a year, we're like, okay, maybe life's giving us feedback. Maybe God's trying to tell us something. Maybe we should go into insurance. And then the market crashed, and we're like, oh my gosh, we were just absolutely protected.
Dodge that bullet.
Yeah, dodge that bullet. Didn't own anything coming into the crash. but it was still chaos. It was like in the rearview mirror, it was a great time to be in that space. But at the time, it was like, real estate's not coming back. Every headline was, real estate's the $1 trillion problem. But we started buying and flipping houses at the courthouse steps in Los Angeles. It was kind of like the only place where there was transactions happening. And we were able to raise a little bit of money from a family friend and flipped a few deals, all cash, no debt, and started building a little track record. And so fast forward, we had a lot of deal flow, as you can imagine. And we flipped about 100 houses and small apartment buildings, LA through Santa Barbara, Sacramento. And then as multifamily started shaking loose and debt started showing up, we started, that deal flow that we created, we started getting multifamily deals and started buying those for huge discounts. But again, it was like, biting our nails, wondering if we're going to be the next guys to lose it. But we built, fast forward, we had, through that market cycle, we built about $100 million portfolio. And then I stepped out in 2019 of the day-to-day operations and kind of wanted to do more impactful work and more, didn't feel like my life calling was just buying old ugly buildings and making them less ugly and raising rents and displacing tenants. And so it was kind of like, gosh, there's got to be more out there. So, little midlife crisis-y moment. And we also got to take our kids traveling and go to New Zealand for 6 months and do some really fun impact projects. But one, like you mentioned earlier, was teaching entrepreneurship at a college in Santa Barbara called Westmont. And it was a blast teaching about redemptive entrepreneurship, impact investing, like how our faith is a faith-based college, how our faith can be activated in the business world, and how like this old model of do business over here and then go to church and give over here is there's an upgrade available, and there's an invitation to have those merge, and there's an invitation to have our businesses be best in class, profitable, and also impactful, and solve real world problems and address crises that we see, instead of kind of blind eye to the ripple effect of your business. Have a real intention about bringing impact. So that was what I was teaching on for 5 years. And so I had all these case studies, because I wasn't my own case study as I was teaching. Like the way we would buy an old building, clean it up, the rents would go up a lot, and a lot of families would be displaced, and we'd kind of shrug, and like that was just what happened. And instead, I'd highlight that in the class, but then I'd also highlight companies that were doing amazing work. And one of them was DLP Capital. I hadn't met them yet. And I'm like, here's a real estate group that does exactly what we did at scale, $5.5 billion under management. We were nowhere near that big. And they are best in class, phenomenal returns, solid investment company. And they track, they measure and track their impact on the tens of thousands of tenants in their buildings. And so I was like highlighting, it was not either or, it was both and. It's like, that's like kind of the idea with redemptive entrepreneurship. And so fast forward, they're a case study in my class, and then I ended up getting to meet the founder at a redemptive real estate conference. And fast forward there, I joined forces with them about a year ago, and really believe in their story. I get to raise capital out here on the West Coast, kind of in my investor circles and beyond. And love telling their story, because it's something that I really resonate with. It's something that feels like I really want more and more multifamily operators to understand the impact that they can have, that's available, and it's not extractive from the bottom line, it's additive to the bottom line. And I can go into that more later. But that's sort of the story of how I ended up here.
Hey everybody, quick interruption. This is Matt Love, your host of Cash Flow Conversations. And if you're interested in setting up your own cash flow structure so that you can save first and spend second and increase your net cash flow, please click the link below, set up your free one-on-one call where you can get me one-on-one, 30 minutes on a Zoom call, and we can go through where you are currently and where you want to end up. Our job at Cash Flow Architects is to show you how to increase your cash flow before retirement years so that you can create a life that you don't want to retire from. Ideally, in ways that are incentivized by the IRS. So we talk about taxes, cash flow, assets, all the good stuff. Click the link below, set up your free one-on-one call, and we'll see you there. I think it's wonderful, man. It's funny. It's ironic because you're doing something, you did it well. You were like, it's not fulfilling anymore. And Lord knows humans get rate of return on fulfillment.
Right. What do they call it? Eternal rate of return?
You got it, man. Internal, external, eternal rate of return. Yes. And you have a moment where you call it a midlife crisis. I call it just listening to your heart. You stop what you're familiar with. You go teaching and start giving back more. And you acknowledge that you could have done it better had you kind of known this when you started. But life is a journey. We figure this stuff out as we go. So kudos to keep going forward. Like, you don't know where you're going to end up. You didn't know you're going to end up at DLP. No. But you knew that was the direction you wanted to go. So that's the coolest part about the entrepreneur's journey, is that we don't know what the result of the next step is. So I just want to know what the direction I want to go is. I get to be clear on the direction. I don't know what the results are going to be yet, but I have faith. So super cool, man. And DLP, then you meet with them, you get along, and then they bring you on board, help raise capital. Talk to me about this word you used, redemptive investing. Like, when you say redemptive, what does that mean to you?
Yeah, I mean, it has, I'd say, multiple meanings out in the world. I don't think it's a super popular term yet, but when your efforts of your business, direct efforts, not like, hey, we give 10% of profits over here, which is awesome too, and I would call that more indirect. When your direct operational strategy, your business model, has a redeeming quality, has a real world problem that it's fixing or addressing, or problems. And like in DLP's case, the loneliness crisis, or blue collar workers that don't have landlords that are considerate of their families. Like, we invest heavily. Like, we have I'll just zero in on that for a second to highlight it, because instead of talking theory, I like to talk practicality. Our housing fund has about 12,000 units in it. And so that represents about 30,000 tenants. And in every one of our properties, we have about 52 as of the recording right here. We've got resident managers that live, at least one, some of them two, that live on site, their job is to connect people. And their job is to help create and foster relationships on property. And be, from practical needs, getting someone to the airport, to connecting people that love kayaking, and they're just there to help create a thriving community. We really believe in building thriving communities. And what happens is then, we have direct efforts, but then all these indirect things start happening. A thriving community starts building over time, over years, and it's like out of our hands then, because people want to have friends. They want to live in a place where if they have to run to the ER in the middle of the night, they can hand the baby monitor to their neighbor and feel safe with that. Yeah. That creates a home. It's not, it's not a white picket fence and a lawn that creates a home. It's neighbors and community. So that's true for us. And that's what we want to have presented in our business model, and a ripple effect from our business model. So it's coming back to your question, what does redemptive investing look like? Like that is, something that we're passionate about, gets us up out of bed in the morning, that we get to do work like that, but it also adds to the bottom line. And that's where that's where the differentiation of charitable efforts and business efforts, like the merger of impact investing is. And it's not concessionary. It's not like, hey, we're going to just give you a 5% return because we're doing all this good work, which is fine. And there's a space for that. We're like, hey, the efforts that we do add to the bottom line. People stay, when we track this, people stay in our communities 2 to 3 times longer than the national average. Wow. What does that do for our occupancy? What does that do for our referrals? Wow. Our turnover is less. Our deferred maintenance is less. People take care of the places that they appreciate. Tenants stay on average 11 or 12 months, and your average tenant in the United States, because they don't feel known. They'll move for a $50 rent reduction. Yeah. You're not going to move for a $50 rent reduction if you're part of a community and your kids have a library to go to, or an after school program to go to while you're working 2 jobs. So these are, practical needs and life needs that, again, add to the bottom line and make our investments more stable for investors, reduce our deferred maintenance costs and our turnover costs, our vacancy goes down. These are all things that we track and display, like in our impact reports. Awesome, because it's like not just the fund performance. We're highlighting what we get to do and participate in the lives of our tenants.
And you sent me the impact performance over the last 20 years. What a unique document. As I was going through that, I'm thinking, I've never seen a real estate company or
Right.
investment company ever have an impact,
Right.
let alone hire people to manage and quantify the impact.
Right.
Because impact is sometimes hard to quantify. It's emotional, it's feelings, it shows up in what you described as like less vacancy. People aren't leaving for $50, but quantifying that impact report was really, really cool. I'm going to throw a curveball here.
Okay.
So my background was in architecture, and I got into this cash flow world just like all of us, just wanting to know the direction. And I knew I wanted more because architecture wasn't fulfilling. You work with a billionaire on a $20 million home. How much impact am I having just doing details on a foundation wall? It didn't get me out of bed. So, but in college, dude, my master's, I focused on urban design. Have you ever heard of the company Dwani Plater Zyberk?
I haven't.
DPZ.
Okay.
Write their name down. I would think you would love what they do. It's just a DPZ design. I don't know what they call it anymore, but it's a husband and wife. They wrote a book back in the 80s called The Decline of America. The rise of suburban sprawl and the decline of the American dream.
I think I've heard of this.
And it was all about how after World War II, baby boomers came home and they stamped the same houses out all down the street, no uniqueness. And then they allowed the street design to be taken over by engineers. And engineers were quoted as saying the wider a turn, the less impactful it'll have on a car. So the car doesn't have to slow down around the curve. Well, what does that do to the pedestrian? If the car's not hitting the brakes around the curve, the pedestrian is secondary in a traditional neighborhood, in the post-World War II neighborhood.
Right.
And our lifestyle was behind the windshield of a car. This fascinated me because cool buildings are fun to talk about. There's principles involved, there's theory, there's design, but communities are what we wake up in and how we spend our time. And so I was drawn to the big picture of how do I experience my day-to-day life, and how many times do I have to start the engine of my car to get to where I want to go?
Right.
Well, then DPZ designed a neighborhood down in Florida called Seaside. Then that was back in the 80s. The houses there are multi-millions now. And when they did it, it was just a beach. They did Rosemary Beach, Florida. They did Alice Beach, Florida. I think a piece of property on Alice Beach is $1.5 million for the property, like 3,000 square foot property. So what you end up seeing. So go ahead.
They created something in demand that the people wanted.
And people didn't know that they wanted it because people were so used to just getting in their car and going on these big collector roads and not actually walking to meet your neighbor. You might see your neighbor taking the trash out. Right. And then the neighborhood that you
close the garage button and you walk right into your house.
And you're walking down the sidewalk with cars and you're looking at a house that is 30-40% garage door.
Right.
And then the old neighborhoods, they had alleyways in the back. They had private spaces that people could use. How many times have you seen a big neighborhood with a big old side yard and nobody's ever in the side yard because you're not using it? It's wasted space. Well, look, I have 2 acres. Well, what does that do for you? Cool, you have more land. How does it affect? So all this to wrap up to the neighborhood that I met you in here in Franklin is designed by the same firm, DPZ.
Okay.
And I put almost 1,700 miles on my golf cart in the last year because that's the lifestyle, dude. Bro, and the price per square foot in the neighborhood is like 50%, probably 50% higher than a mile away because it's such a desirable place to live. So I don't know if you ever wanted to do research, check out that book, DPZ, the Rise of Sprawl and Decline of the American Dream. You guys, it would be aligned right with what you guys are doing at a big scale.
100%. And that's like the space we're in. I love that. Yeah. Cause it's thoughtful design. And even though like our properties aren't architectural wonders, they're apartment buildings, with amenities and a pool and a clubhouse, but it's like the college experience. If anyone got to live in dorms with friends, like there was one of the most fun times of life, not because we had a, big living room and views, and like we're all crammed in each other, but you're with your friends, you're with people that
Yeah.
got your back, and
Twin
you
bunk
like
beds stacked on top of each other, trying to drink Bush Light.
totally. So that's the space we're in, and we get to we're not selling sprawling places with big yards. Like we're providing housing, clean, safe, affordable housing, and the ability to become part of a thriving community. And that's what people want, and that's what DPZ had vision on. It sounds like way ahead of time. Is like people want to interact, people want to bump into their neighbors and know them actually, and you can't. Everyone's so busy, like you have to have those natural crossovers, and apartment buildings are the place where there's more potentially natural crossovers than anywhere else, because you're living in tighter quarters. And
Tighter
so
quarters.
right,
I look
right.
back at going when I was the architect, and what I didn't like about architecture is that architects have a big ego. And a lot of times they just want to create a building for themselves. Look at Frank Gehry. He can't even describe his buildings. He calls them fish scales.
Yeah.
That's a celebration of his own idea.
Right.
What does it do for the community? And so that's why I didn't like architecture. Then I get into the financial world because I see how the IRS takes advantage of some of these assets. And I didn't get along with these traditional financial planners because it was the same idea. It was like one idea they just did over and over, regardless of what it did to the overall well-being or impact that it has for generations. It was all about rate of return and growing a net worth, which you can't spend a net worth. I mean, you just can't. I don't care what the rate of return is. So it's funny how as an entrepreneur, you just have this itch, like you don't know how to scratch it yet, but you just kind of keep getting bigger and bigger, and then you just get closer.
Yeah, stay on the journey, like you were saying earlier.
Yeah. Sure. All right, DLP. So let's talk about what you guys do. You've mentioned a couple of things. Yeah. So you have a multifamily fund, you have credit funds, and I think you said you have debt funds as well.
That's right. Yeah.
Walk me through all three of those.
Sure. So can I start with just a small story of our why, kind of why?
For sure.
And then I'll flow into our credit funds, which is really kind of an expression from that. Our founder and CEO, Don Winter, who's 40, awesome guy, entrepreneur of the year, Ernst & Young, just amazing leader. He was born to two 16-year-old parents, had to drop out of high school, and him and his siblings had to move like over 30 times growing up. So a disruptive childhood, housing instability was the core of that. And, how many dozens of schools he was at. So when he went straight into real estate right out of school, and just wanted to dedicate his career. His mission was, I don't want to have another generation have to go through what I went through. So it was like, I want to create safe, affordable, attainable workforce housing at scale. And so he started DLP 20 years ago, which means dream, live, prosper, by the way. And so the mission, he figured out pretty quick, I can't do this on my own. We need to create debt funds to fund builders that are providing attainable workforce housing, that believe what we believe. They want to see more of this. And so not only do we have our investment funds, we created debt funds. Like our flagship lending fund has been around for over, I think it's 10 or 12 years. And that fund is now $2 billion. We provide bridge loans to developers of workforce housing, mostly in the Southeast, but we're in, I think, in about 34 states. And because we can't do it on our own, there's a housing crisis. We've got a massive need in our country for more affordable housing.
Yeah.
So that fund is really fulfilling that. So I kind of want to start with that, because Don's not building this company to sell it. He's not trying to look for an exit. He's on a mission. And when you work for a man on a mission, it's pretty fun, because everyone just sort of catches the vision, and it's not just about, your weekly, monthly numbers. It's about something bigger. So the funds, I want to, start with that, because the funds are an expression of that, and which is cool when you do it that way. You start with your why, and then you kind of create your business model to satisfy that. So we have two credit funds, the lending fund, which I mentioned, which is all senior secured first mortgages on bridge loans on developments and housing projects, and usually about 2-year loans on average. That fund has done about 10.5% over its life. Its target return is 9 to 10%. It's super liquid, has 90-day liquidity. So investors love that feature. Another kind of unique thing, we're investor friendly, is we only pay our management fee after the preferred return is paid to investors. So we're really investor friendly in that way. Our preferred credit fund does some more mezzanine and second mortgages. So in that same space, we're providing bridge financing to developers. That also has 90-day liquidity and is done a little bit better. It's done kind of 10.5, 11%. And all the preferred returns are paid monthly. The excess distributable cash is paid monthly. My parents just invested in that. They're fixed income retirees, and they were in a 3.5%, fixed something or a bond and
CD,
CD. And I'm like, hey, jump over here. So, you only put your parents in something that you really believe in. So those are our credit funds. And then we have our housing fund, which I mentioned, that's got about $2 billion under management, 52 properties. That one is an evergreen fund. So it's sort of unique, where a lot of investors that might do syndication, it's a closed-ended, single purpose, usually single asset. That's what I did before. We'd find one deal, we'd raise $5 million, and it'd be a 2, 3, 5, 7-year hold, depending on the market cycle. Not liquid.
Not at all.
The housing fund is designed as an evergreen fund. So it doesn't have an end date. It had a start date, doesn't have an end date. So we're marking to market every year, which creates a lot of visibility into our performance. I like that feature. It has annual liquidity between March and April every year, so people can exit out of the fund. You have appreciation, so we pass along the gain in the portfolio to investors. So it's it's like if you bought a duplex on your own, you're running it, had a little cash flow, you're going to realize that appreciation. This has the same feature, but diversified across a lot more assets with professional operators. That pays a 6% preferred return, paid monthly, so you do have cash flow from that. And the thing I really like about that fund is the depreciation. So we can pass along depreciation. As you're a huge fan of any kind of tax strategies, and since the inception of this fund, our investors haven't had to pay any taxes on their distributions, so they're able to.
We can't. I'm not going to let you just skim over that. I'm not going to let you do it. I work with high income professionals. The hardest part of a high income W-2 professional is they go to their CPA, who I call a historian, and they say, "What can I do on these taxes?" And the CPA says, "Max out your 401k,
right. HSA,
yeah. Defer the tax. Don't deduct it, defer it." And then they say, "That's it. We can't do anything else." It is such a disservice to high income professionals at some level of income, over usually $500,000. You need to start treating your income as a business. We need to look at income as revenue, and you're making enough money to start building a team. Hire specialists. They're not even expensive. If you hire the right specialists, you'll save more money.
Right.
By building those people around you that specialize in things that you need help with, that you might not even know you need help with. But if you're listening to this and your CPA is saying you're high income W-2, there's nothing you can do, click the link below, set up a call, because that's not accurate.
There's more
there's more you can do. We got to design it into the plan. The cash flow structure, baby. This is all architecture. It's just a different medium. It's not bricks and stones. It's cash and debt.
Strategy. Mm-hmm.
So when it comes to high income, like the government, they outline what they want us to do. They don't incentivize saving. Putting money into a 401k or a SEP IRA is postponing a future tax bill. By the way, I would argue that you're going to add on more ancillary taxes when you get older than what you're deferring today, but that's another conversation.
Yeah, that's another podcast.
Another podcast altogether. So there's things you can do with your money today that would help the economy. That's the bottom line. Help the economy grow, and the IRS will give you breaks for that. So how do you do it? Number one, take care of your family. They don't want families on welfare and social services. So they give tax incentives for that. Number two, business, help the economy grow through GDP. And finally, real estate, give people places to live and work, and you get massive tax breaks. So the consumer making $800,000 a year as a W-2, they're going to make the money and either give it to the IRS or invest in ways that the IRS will say, all right, instead of giving us the money, you go do that. And now you get tax breaks for the rest of your life through depreciation, through cost segregation, through deductibility, and then realizing growth on assets that you're not even paying tax on the growth of the assets either.
And like you're saying, you don't have to understand every single bit of that. That's all hireable. That's all. Like in your business, you don't need to understand and be an expert in every single vertical in your business. You can hire a team that knows what they're doing, that believes what you believe, and that can help you with all that. So
there's a level of entrepreneurship bug that a W-2 employee, high income employee has to have. They have to say, look, I'm overpaying the government. What can I do? And with technology today, man, I mean, 20 years ago, this was really hard to find. You'd probably spend a lot more money and search a lot longer than you have to today, because there's people out there that specialize in that.
Right.
You know, if you're making a good income and you have leftover cash at the end of the year, spend it in a way that the IRS will incentivize. And you guys do a great job of doing that and adding in this impact component that you really don't get in the real estate world. It's, you know, real estate's always about bottom line, cutthroat. You mentioned raising rents, and that doesn't feel good after a while.
Yeah. Yeah. It's, I mean, I think I'm encouraged, a generation, certainly the younger generation and our generation is starting to, you know, has, I don't know, in the last 5 or 10 years seems like really woken up. I'm like, wait, where am I? What are the ripple effects of my investment? What is my portfolio actually enabling and investing in and allowing? And does that align with my values? Do I want to see more of that in the world? Do I want to, because we can't be living in a life of integrity is like, you can't have a blinder on in one area and then, you know, have these values that play out just on, you know, in your family or just on Sundays. Or just
I think the Bible talks a little bit about that too.
I think there's some stuff in it for sure about that. So that's really, again, I'm encouraged because people are asking those questions. They want to know, and historically, real estate, you can make a lot of money if you just hold long enough. You know, if you don't do bad deals, and you know, you don't have to be particularly brilliant or creative. You just kind of can figure out how to hold on to an asset long enough. You do well. Yeah. So there has not been a lot of innovation, especially you know, my world is multifamily real estate, so I'm mostly speaking about that. But you don't have to treat your tenants particularly nicely or fairly or invest in their lives in order to have a full building. Tenants generally are a line on a spreadsheet somewhere that someone's making decisions about. Yeah. Where in reality, and this was some of my wake up, like these are lives happening in the assets that we own. These are marriages and divorces and promotions and birthdays and you know, retirements. Life's happening in our buildings, whether we choose to acknowledge it or not, and we get to be stewards of that. We get to participate in that to some degree and influence that. So yeah, so I love when people ask those questions. I mean, there's a lot of impact investment groups out there. There's not a ton of real estate ones. There's some that are phenomenal that we love to compare notes with. But I'm really proud that, you know, within the assets that we steward, we really get to take that seriously and provide passive income and provide stability. You know, our avatar of investor usually is someone that has, you know, concentrated somewhere else. Now they're diversifying, you know, as Justin Donald talks about. They've made their wealth somewhere in their business, and now they don't want to lose it. You know, they're not looking for 30 IRRs. They're not trying to swing for the fences. They want some, you know, trustworthy company that has monthly income, solid returns, a good track record, audited, and that actually that cares about what, you know, the impacts of what we're doing. So that's who I get to work with. I really enjoy our investors because they're excited. They want to see the impact report. They want to know the returns. They want to know where the K1 is. But then
they just send it off to their team, and then what are they going to read? And like, I was just thinking as you're talking, I don't know any clients that have ever gotten excited about a SEP IRA statement.
Right. Yeah. You know? Usually not a lot of like good photos you can put in that or stories you can write about that, but it's fun. We have thank you cards from residents and videos that come in, and like we get to highlight those as a team at a couple times a year, and just remember, like, this is happening. And sometimes it's things that we put into place. Sometimes it's not. Sometimes it's just things that are coming out of this thriving community. So yeah, that's a fun part of what we get to do.
I love it. And I think anybody listening probably is already a little inspired, but like if you met somebody off the street, I know you raise capital, high income earner, whether it's W-2 or business owner, you know, maybe they're maxing out a SEP IRA. Why might private real estate, be a better fit than another year of deferred market correlated growth?
I mean, you'd probably be a better response, a better one to ask than I would. I am like 95% allocated to real estate. So you're going to get a very biased answer, but I think for a lot of our investors, I'll just answer kind of anecdotally. For a lot of our investors, they like real estate. Most of them have owned real estate at some point from an investment standpoint, and then at some point realized, amidst raising kids, running a business or a job, that I can't be a landlord to, or I can't be a good, I can't fix the toilet at 2 a.m. and figure out the roofers when they're going to come. So there's a desire for real estate as an allocation in their portfolio, the depreciation, like we talked about, but also just the hard asset. Like being in the markets, like, man, I have a hard time understanding when my money's out in the marketplace. I'm like, I don't really understand it. Real estate's simple, and I like that. And a hard asset, even like through COVID, man, real estate, the government was mandating people lock into the assets that we own. Like that didn't become irrelevant. Other classes of real estate, were highly disrupted. We were in some ways, but the government mandated people to stay in the assets that we own. So there's a
let's look at Airbnb during that. Airbnb did not do well during COVID.
No. I mean, people got hammered, for other reasons, but it wasn't demand. People needed housing, and so I think that's long answer to your short question. I think
no, it's good.
Kind of scratches that itch.
So when you look at 2008, when you got started, I mean, that was a massive decline in the market. But the secret is the only way to lose money is to sell at a loss.
Right.
So if you could have held on to your assets through that, you would have been just fine. And then there's a lot of people that made a boatload of money since 2009 because the market had declined so much.
Right.
Can you talk about that a little bit? Like, what did you see during that time frame? Who was crushing it for those few years?
Yeah, I mean, no one was really crushing it until the market came back. I wish we backed up the truck. I wish we looked at, bought every single thing we looked at, because, we'd be gazillionaires. But we were really, really trying to be, just scrutinize deals, and we were trying not to lose money. And in that, if we could figure out how to not lose money, we'll probably make it and have the staying power and be able to sell at a gain. But the people that did well, I think had discipline and still were buying on fundamentals. It was like we were buying at a huge discount, to replacement value. And when you're doing that, there's some, and not over leveraging. We were if we were using leverage on a multifamily, we were using as long-term loans as we could get, with a lot of times with relationship lenders, which reduced some of the risk and allowed us to.
How much would you lend out or would you borrow on a property typically?
We would never go more than 65%, and DLP is the same. That's usually where we'll kind of come in at.
Well, one quick before you keep going out, because you said you go long on the debt. I wrote a book about this. Why would you go long on the debt? What was the thought process there?
There's debt's costly, so that's one component. Less refi costs. If we're satisfied with the yield at that interest rate, then locking that in and having that stability for as long as we could possibly get, whether 7 years or 10 years, gave us a roadmap on how we could operate this property and to fix. It's like variables will get you in investing, right? And the more you can simplify or reduce variables, then the more you can just focus on executing a business plan. And so by locking in as long-term debt as we could, we were reducing that variable or that risk that we're going to have to refi at an unfavorable interest rate or with an unfavorable loan. So that was, we were always very motivated towards that.
I love that answer. I didn't know where you were going to go with it, but I love the answer. The variables really increase risk.
Totally.
And when you don't understand the variables, that's when you're going to get in over your head. And by locking in long-term debt, sorry, Dave Ramsey, it might be a way to actually reduce the risk that you're exposed to.
Totally. And I'm specifically talking about multifamily real estate, often other kinds of real estate, but that's really how even DLP came through. This is a rough couple of years for multifamily with the interest rate spikes over the last several years. A lot of groups got hammered. A lot of people gave back the keys on their properties. And DLP, when I came aboard, being in a multifamily operating myself, was like underwriting their deals, underwriting their funds, and like, show me your housing fund for the last few years. That's what I want to see. Like, of course you did great in 2021, 2022.
Sure.
Everyone did. I want to see 2024 and 2025 and when
the rates went through the roof.
And they had a positive, like it was their worst year, it was like 9.5%, but it was their first time below double digits, but they had positive net asset value growth. Like, how'd you guys pull that off? People were like, rents were declining, occupancy was coming down. How were you able to have any kind of growth and keep your pref going, not, hand any properties over? And it was operations. It was like excellence in operations and having an asset, something that people wanted to be in. And that's it's a commodity. So having a differentiator of a thriving community is helpful. But they were able to keep expenses flat or reduce them in some cases, squeeze where they could and really maintain, through a hard time. Now we have some tailwinds in the marketplace. So I think that to me spoke to like there's excellence in operations here. Because anyone can make money, like you're asking who made money and through the run of 2010 through 2020, anyone that owned multifamily that wasn't that reasonably are good operators. That was you had a lot of tailwinds,
and it gave a false sense of success to a lot of people. They got a little. And you mentioned people giving back the keys here in the last few years because rates went up so much. People didn't have the cash flow that they once did have.
Right.
It was a big wake up call.
If they had debt that was coming due, shorter term debt that was coming due, like, man, they thought they could refi at 5 or 6%. Nope. We were refining at 7.5, and that gobbled up, any reserves that they might have had.
Yeah. There was capital calls like crazy.
Off from rent. Capital calls, so I mean, people that got out with just capital calls were, I think, pleased if they're still alive, let alone losing their principal. So it was a tough couple of years, and I think our investors. I think we built a lot. Not I think. I know we built a lot of rapport with our investors because they had a lot of other deals go sour, and so we've got a lot of most of our capital we raise is actually from our existing investor base because they get their K1s on time. They like the reporting. They are pleased with we do what we say we're going to do. And we've got about 4,000 investors at this time that are families. We don't take on institutional capital. We work with RIAs and we work with wealth managers, but we don't take on the big institutional capital because we like the relational side of it. It reduces our risk and investors' risk by not having a big institution that can pull all their capital because the Financial Times, said this or that.
So that's a variable. If you get somebody could get excited that they want to put $1 billion into the fund. Well, if that takes up, 30% of the fund, mm-hmm. that's a risk.
And then all of a sudden they want to redeem. Well, that's going to affect everybody in the fund.
Yeah.
So that's a decision.
Which I think is a good testimony of sticking with your why. And not allowing high returns and success over a decade of growth,
right.
Get you sidetracked on, okay, we can make more money by violating our principles. You got stuck to the principles and you got through that craziness. Because I have a friend, this time last year, I walked by and he's pulling his hair out and his head's down. I'm like, what's going on? He goes, we just have to raise more money. Capital call, multiple, close
Not
to 8 figures. And it's like,
wow.
that's not a fun call you want to make.
That's not good for investor relations.
No.
You got to do what you got to do, but it's not great for investor relations. So yeah.
Yeah. So what with what you see with investors, what are some of the biggest, most common mistakes that you see investors make when they go into, like, private real estate funds?
It's a great question. I think I think not doing the it's like you're betting on the asset or assets, but really you're betting on the horse. You're betting on the sponsor. And I've seen enough, in 25 years of real estate, invested in enough deals, done enough deals, and seen enough to know, like, when all is well, and anyone can kind of sail the ship,
Yeah.
uh, metaphorically. But when things hit the fan and it's tumultuous waters, or COVID happens, when you have the curveball, I think it's really those operators that are really committed to values, that have built a team of capable, competent, awesome people that know how to hustle and know how to set goals, achieve goals. And so I think a lot of it is betting on the sponsor. I think that's probably one of the biggest mistakes people make, is they'll kind of get lured in by a great IRR and just be comparing IRRs or comparing yield. But really, that it's like the upside often, they say, like, underwrite the downside and the upside takes care of itself. Like, really being concerned and cautious about the risks, and not being just lured in by the high yields, because it's easy. Like, I've made a million pro formas. I can make the yield say whatever I want.
Right.
Tinker with this, change that, shorten the time period, and I can back into an IRR. So most sophisticated investors know that, and they really want to know, like, if everything hits the fan, what does this look like? What's your track record? How many capital calls have you done? How many times have you missed preferred return? Like, asking those types of questions and really understanding, and getting an honest sponsor that are willing to own their mistakes, because we all make them.
That's really
But
good.
also has a competence. And, like, I actually really like DLP is vertically integrated. I didn't mention that earlier. And we have a building fund that I didn't talk about. We're building 6,000 units, across the Southeast. And so we have a construction company. We have we do our own loan servicing. We do our own property management, and et cetera, et cetera. So all those disciplines cross pollinate and cross check each other's work. If we're making a construction loan, a bank is a bit, usually full of bankers. So they're going out, maybe looking at the property and looking at the plans, but they don't really understand them. We have a construction team scrubbing the plans and on site. And before we do a construction draw, they're inspecting the concrete, make sure it wasn't poured when it was freezing outside, or whatever it is. So there's an additional belt and suspenders on all the funds and how we look at deals. We'll only lend on properties that we could build ourselves. So we won't go lend on a deal that we couldn't, foreclose on if we had to, and then bring across the finish line. So that type of, still long answer to your short question again. Those are the types of questions that sponsors or that investors often don't ask, or really, like, help me understand what your team is, what disciplines you bring in. Are you vertically integrated? Tell me about how you guys did in the downturn. Tell me about how you guys did in those spaces. That is really going to indicate what horse you're betting on, and how they do, and in the off season. So that's probably the biggest mistake I see investors make.
Oh, that's really good. Anybody who loses money once needs to learn how to ask better questions, because you don't want to do it again. Like, I did a fund that I fell in love with the return. I liked the underlying asset, didn't vet the sponsor, and that deal went to crap. And I don't ever want to do that again. So understanding those right questions, and how to vet the fund. And I think the sponsor, to your point, is probably more important than the IRR that's projected, because I'm in the financial world. I've seen people fudge numbers, not make them fake, but make them tell the story that they want to tell.
Right. Easily, much easier done. And this is a personal preference for me, but I think it's prevalent. I like investing with people that I know, or that I have a direct line to, or that I can have dinner with. And And that's one of the things I like, the DLP is maintain the really relational comms with investors. Like we have host dinners all the time and events and investor tours. We have another one in Dallas in October where investors can come see all the properties that we're either building, own, or lending on. And we have dinner and you get to meet Don, you get to meet the team. And that's fairly unique. You don't see that a lot with sponsors. We put a lot of effort into that so that we can build that relationship, so that you feel like you can call and you don't get a 1-800 number. Like that's fine. And there's you can make great investments with big groups that have a 1-800 number. But in this very digital age, to have relationship, to be able to sit down with someone, look them in the eye, it's harder to lie. It's harder to fudge numbers when you're, actually face to face with someone or hosting an intimate dinner. So I think those are helping build trust in an environment where there's a lot of lack of trust in investment companies, lack of transparency. And we see, a story coming out a month of a leader falling or a Ponzi scheme or, so that those I do not undervalue. I think the trust factor and the personal touch factor are important.
So how often do you guys do like investor meetings?
We do dinners, and we have investors all over the country, 50 states and beyond. So we're doing a dinner probably once a month, I'd say, in a different location. We have our big family event coming up in Pigeon Forge at Dollywood, and we have like 800 people that are mostly current investors and their families. It's a family event. We're going to have 3 days of fireworks and water slides and fun. Actually, that was my first intro to DLP, really like the culture. Last year, I went to the family event, and 4 days, it was like tracks for kids and activities nonstop and marriage deals and legacy deals and purpose. And I was like, when are they going to pitch their funds? I was kind of there like to hear the funds pitch.
Yeah.
I had to like pin down someone to get the scoop on the funds, because they just wanted to pour value into their investors, families, partners. Even we host events with other builders that are in competition with us, and we're like, hey, let's just gather and make each other better. And because we're all fighting the same fight here, and we can collaborate better than we can. We'll have friendly competition, but we're hosting events all the time. Check our events calendar.
I love that, man. I don't think we even had an investor meeting in 3 years after me begging for one. It was so poorly run. There was no transparency, but
we had, in fact, I wish we knew each other. We hosted an event at Tin Pan South in Nashville earlier this year. We have a lot of investors in your area, and had a amazing singer-songwriter luncheon where we had Franny Cash. We had a couple amazing country artists. And to show how family oriented, even I got to go, and they invited my daughter, who was 16 at the time, who's a singer songwriter. She got to play before everyone else and share one of her originals.
Cool.
And all my investors loved it. They're like, we would rather see your daughter. So it's fun when we get to kind of break bread. There's nothing like breaking bread together, and so it's something that DLP puts a lot into.
Well, I'm not far from Pigeon Forge, so we'll talk about that offline.
Yeah.
We went up there 2 years ago. We got a cabin in the mountains, went up with another family and spent like 3 days, Dollywood, all this stuff. And it was beautiful. It's beautiful. Especially in the fall, it's like incredible.
Yeah. I think for a California boy, it'll be fun. It'll be fun to get in some different terrain.
Yeah, some Smoky Mountains. It's really beautiful because the clouds literally are right in every morning. It's like you see these clouds and all the mist. It's just beautiful.
Amazing.
A couple more questions here for you, because I know that one more business question. Then I want to get into faith and mentors.
Okay.
But when you talk to potential investors, do you have like a rule of thumb about liquidity before committing a certain amount of capital? Do you talk to people about that much at all? Or do you leave that to the RIA? Or what's your opinion on, of all the liquidity, how much should be going towards X?
So a couple questions there. We generally, when someone's interested and someone's onboarding and I'm talking, I like to know as much about them as they'll share and as is appropriate. not even just financially. Like, how many kids do you have? What are your kids' names? What season of life are you in? Because we just, we care, and it makes a difference. It matters what fund we might recommend, or how we might structure something, or how we hold it in a trust, whatever. So generally, we're not asking for their whole financial picture, and they might share their allocation strategy, but we don't pry too much there. So we kind of allow them and their strategists to come up with that, and because we don't give financial advice. I
Yep.
probably should have started with some disclaimer. I'll
Yep.
probably get in trouble here.
I have the disclaimer too, so don't worry about that.
Copy paste it for me too,
Yeah.
so I'm get in trouble with compliance. But yeah, they're generally coming up with that strategy with their advisors, and like I said earlier, we work with a lot of wealth managers and RAs who love us, because that's, we've been vetted by all the proper channels and whatnot to make it easy. We work with Fidelity, Schwab, so we're on all those platforms. But we love to be their impact real estate fund, or they'll often have a credit fund that they like, and it's fun when we get to be that, because that's a great relationship channel for us, to have people that know their stuff, that are saying, hey, this is a good group, I invest there, and to get those funds. And they're coming up with that strategy. Did that answer your question, or did I skip?
Yep, it does. Absolutely. Yeah. And I know you're a faithful guy. So how has faith impacted this journey for you?
Oh man.
I heard it in little parts of the last 45 minutes. I heard it coming out, but
Yeah.
How has it impacted the direction that you've taken your career?
Yeah. Thanks for the question. And uh, I'd say in the earlier parts of my career, it was integrity, best in class. It was, wanting to pour value into our investors and people that we did business with. And then I'd say it's expanded really to want to have the work that I'm involved with have a bigger ripple effect. Specifically, learning about how God speaks to me, learning about how He calls is, man, I've learned a lot, and I've unlearned a lot, and thought I had it figured out and didn't have it figured out, but kind of discerning, leaving a phenomenal company, like I said, in 2019, or leaving the day to day. I still own a lot of the company, with a wonderful partner who I'm still very close with. That was scary. That was hard. It was like, why would you leave? When you're at the top, or on a great trajectory. But it was like stepping out, like feeling that calling, feeling that stirring. Those have been big faith journeys to step out and say, this doesn't make perfect financial sense on paper, but God, I know you provide, and I know you're looking to put me in a place where I'm thriving. Like, you're looking to put me in thriving, not just financially. Like, usually that's somewhere down the list of thriving. I think, like, so learning to listen, learning to tune into that still small voice, as I've discerned my career trajectory in the last few years. You can read only so much about something. You got to go do it. You can read about ultra running, but it's nothing like signing up for your first 100. And that's, I think, what the faith journey has been for me. Like, I can, like, a lot of my earlier years was reading about it and hearing sermons and podcasts, and then the faith in action is like where it gets exciting and wild and messy and twists and turns and in confusion and peace and not peace, and all those things have come up. The more I've kind of walked out, the more I've really put my life and my family in His hands, and my direction in His hands. So that's where I'd say, like, specifically kind of how my faith has affected my career journey in the last several years. I thought I was leaving real estate. I was like, all right, I did that, it's extractive. I want to go do something impactful. I want to change the world, and so in God's, infinite sense of humor, like, brings me back into real estate, in the same exact, category, to have kind of a different North Star.
What a phenomenal answer. You didn't leave real estate, but you did leave your why. Your old why grew.
Yeah. Yeah. It expanded.
Because when you're young, we're trying to make money, and it's like, all right, I'm better than this. What am I missing here? Yeah. And all you have is faith, and it worked out. I could say similar about architecture. Like when I left architecture, I'm like, I'm going to leave. I used to say I'm not going to do drawings anymore. Well, I don't do drawings anymore. I still do squares and triangles and circles and lines, and
models of cars.
Models of cars. Yeah. It's still architecture. It's just a different medium. It's still putting things together. Like if you had a pile of bricks and wet concrete with 2x4s all just laying out over the job site, you still have to put it all together. You can have savings accounts and IRAs and SEPs and real estate and business. If you don't put it together, there is no structure.
That's all your construction materials now.
It's just different medium. Yep.
That's cool. That's cool. I love
all right, Deyl, how can people get a hold of you? How can they find you? And I'll put your links, so anyone listening in the description below will have some links, but how can they get a hold of you?
Yeah. I mean, DLPcapital.com is where you can find out more about us there. Shoot me an email or text, 805-724-6350. I love getting to know friends of friends. And those are probably the best places to find me. I'm on social media, not as DLP, just as the adventures of Deyl Kearin. So you can. And
I'm going to spell it in the description. So
because everyone's going to be the spelling Deyl. As far as I know, I'm the only Deyl out there. Like if you Google my first name, you find me, which is like good or bad.
Yeah. Well, it's better than me, dude. If you Google Matt Love, this guy got arrested in like Seattle or something for like underage stuff. Oh, and his mugshot pops up, and I'm like, how do I get my SEO better than that guy's?
Yeah, that's not good. Yeah, like cash flow architects, not that guy.
Yeah, not that Matt Love, different Matt Love. But Deyl, awesome hanging out with you today. I'll have you on again too. We can talk more about some of these funds and how they're going. But if you got through the last few years, and I cannot tell you how much it is good to hear about impact investing for real estate, because you hear the government say we want to get institutional investing out of real estate. What they're really talking about single family homes, which is pricing millennials out of entering home ownership. That's not at all what you guys are doing.
No, we want, I hope there's 10 DLPs out there in 5 years. I hope there's 100.
Good for you. So you know what Elon Musk said one time? He said, patents are for losers. All of the stuff that Tesla does, they don't have patents on any of their technology. He said patents are for losers.
It's like go make something better than I made. That's the free market.
That's right. That's right.
That's cool.
Deyl, awesome having you here, bro. Everybody listening, don't forget to hit the subscribe button down below, and we'll make sure that you get access to the next podcast. But Deyl, enjoy surfing today, man.
Thanks, brother. Been a pleasure. Let's see you soon, Matt.
All right, bye.